Starting. Good afternoon, ladies and gentlemen. This is Carl Holman, Marketing Director here at Foundation Mortgage. Happy to welcome you to today's Foundation Fridays webinar. We're going to have a very interesting and lively discussion today with two of the industry's experts. We're going to give it about a minute or so for people to start trickling in. We'll go through some ground rules in the agenda. I'll make the introductions of our two speakers, and then we'll just kind of dive right into it. We got lots of charts, lots of data, all kinds of good stuff for people to digest and absorb. Um, all right. So we'll see what happens with our spring housing market. Like I said, we've got uh, close to 100 people that are coming in. So we'll get, so hopefully everybody's off to a good start this March with their pipelines. And hopefully today we will impart you with enough knowledge that will get the rest of your month and hopefully April and May in even better shape. Okay. All right. Let's go ahead and we will get started. Sorry, we got a couple of AI bots going. All right. Hi. Okay. Again, my name's Carl Holman. I'm the marketing director here at Foundation Mortgage. For those of you who may not know who we are, we're one of the top non-QM lenders in the wholesale lending space. We deal principally with and directly with brokers. We are based out of Miami, Florida, but we're licensed across most of the states. We also do a little bit of non-delegated correspondent lending. And here we're really focused on a white glove service, providing brokers with knowledge about non-QM if they're not familiar with it, and trying to help close all those challenging loans that are out there. Um, so just really quickly, our footprint, again, we're licensed across most of the United States. We're hoping to fill in the middle part here this year, but we're in decent shape there. We do about, I think we're licensed in 40 states to do business purpose only loans. So, and we've been doing this now for about 20 years, and most of our team is comprised of industry veterans. So we have pretty much seen it all, done it all, and we're here to help close your loans. And speaking of experts, today we are very happily joined by two of the leading people in this industry when it comes to commenting and data analysis of what is happening in real estate, mortgage, insurance. Um, so first up is Dr. Selma Heap. Sorry, I have to do the doctor. It's my formal training from working in higher education. She is the chief economist and senior vice president at Totality, where she heads up a group that oversees all the economic trends affecting real estate, mortgage, insurance. She's been doing this for um, about 20 years and has been linked to a number of major companies. And Totality, I believe, is the largest provider of data used by most lenders in this industry when it comes to mortgage and insurance, or sorry, mortgage and other real estate property stuff. The next person is Rick Sharga, my old boss at another institution and founder of and CEO of the CJ Patrick Company. Rick and I have done these webinars together now for a number of years at varying institutions. It's always turned out to be very popular, and I have yet to ever see Rick be wrong, which is if I could just get you to give me the lottery numbers, we'd be golden. So again, Rick's been doing this for 30 years. You probably have seen him on CNBC, MSNBC, New York Times, and probably 1,000 other webinars and podcasts. So I am Very excited to have both of them here with us. So we're going to cover a wide range of topics today. We're just going to kind of keep it a little loose, but so today we're going to talk about the spring market forecast. So if you specialize in non-QM loans, you probably already know that you don't compete in a pretty regular part of the market. You're handling very complex deals, and when you do that, you know that to close these, that the structure of the deal matters, and that you're going to win mainly when you work with lenders that don't hesitate. So today is going to be helping you guys identify where those opportunities are this spring and how to position yourself to be there before your competition. So with that, I'm going to turn it loose to Rick and Selma, and we're going to just kind of jump right on in. Um, so first, we're going to start a very high level in terms of the macro economy and what signals are out there you should be looking at when it comes particularly to non-QM. So, Rick, let's start off with you from sort of a big picture standpoint. What shifts do you see heading into the spring that could impact, things like credit availability and the appetite of lenders, including ourselves, uh, to want to do some lending in this headspace? Um,
Well, I guess the good news is that, and thank you for inviting me to participate, and especially to participate with Selma, who is one of my idols in the housing economy market. Um, the good news is credit availability is actually pretty strong. It's been coming back. If you were to look at the chart on the left, going back historically, you would have seen it credit availability much looser back in the early 2000s, which unfortunately is one of the reasons we wound up having the great financial crisis, the Great Recession shortly after that. But lenders tightened things up, but over the last year or so, we've started to see a little bit more credit availability, and that's pretty much across the board. Whether you're looking at conventional loans, Fannie, FHA or VA loans, which are in the government sector, jumbo loans, and conforming loans, which have been of the group have been a little bit tighter than the rest. All that said, there have been two recent events that kind of skew things a little bit and put us into unknown territory. And I'd be curious what Selma's thinking about them. One, of course, is the war in Iran, which has sort of roiled the oil markets. Oil this morning was up over $90 a barrel. I'm not sure where it's trading right now, but that has an impact on pricing, not just for gas for U.S. consumers, but for many other parts of the economy as well, and could seriously slow down economic growth if it's more than just a blip on the radar. And the other, of course, is today's job numbers, which came out unfortunately after Selma and I had a chance to do our
mhm.
slides. And were very disappointing in the month of February. I think we lost about 68,000 jobs.
Yeah.
And the consensus estimate was that we'd see a job gain of about 55,000. So the jobs market's been a little disappointing. Um, Jobs tend to go hand in hand with both mortgage applications and mortgage delinquencies. So we saw the unemployment rate tick up to about 4.4%. And the slide you almost popped up there for a second really is one of the other potential red flags in the economy right now. We're at a new record level of consumer debt. This with the charts you're seeing here are Q3 data from the New York Fed. They recently released Q4 and consumer debt's now up to $18.8 trillion dollars. About 70% of that is mortgage debt, which is offset by about $36 trillion dollars in homeowner equity. But we're at near record levels of auto loan debt, student loan debt, credit card loan debt, and delinquencies are rising across the board, which suggests that as people are accumulating debt, they're having a harder time making their financial commitments. So we're getting mixed signals, but it does look, if you look at consumer debt delinquencies and the jobs numbers, that the market, the economy at best may be slowing down a little bit. And with some of these unexpected issues like a war in the Middle East, could slow down even further.
Mm, okay. Before I jump over to Selma, really quick, if people have questions for Rick or Selma, go ahead and type them in the Q&A and we'll get to them towards the end of the program. Um, And with that, Selma, so from an, again, kind of echoing what Rick was talking about, do you see, are we heading into expansion, some kind of continued constraint, especially for those borrowers that aren't going to fit inside the agency box?
That's a great question, especially now that things, outlooks are changing on a daily basis. As Rick said, one day we're thinking we're in a good job market, the next day we're in a bad job market, and then you have these black swan events like Iran that really, throw a wrench into the outlooks. So, um, I can talk about this real quickly, but this is outdated at this point, like Rick said. But the the point really is, first of all, the level of job growth, which is the bars portion of this chart, has slowed significantly. You can see, some declines there, but there was projected increase throughout 2026. Now, what's important about a job market going into 2026 is that our need for job creation has slowed because of partially contraction of both supply of labor, right? Think about the immigration policies that are, removing some of that labor out
Hmm.
of the country. In addition, we have lower participation because people are aging out of the labor force, so, people retiring. So supply is lower and the demand is lower. So, that break-even point at which you start seeing unemployment go up is much lower. Those are these blue and green lines, and I'm showing how 2026, the green line, that line is even lower. So we don't actually need to be creating that many jobs in order to not see rise in unemployment. That just means that, we're sort of in this frozen period. We had like frozen housing market. Now we have a frozen labor market. And, people are not moving in a sense of a new job, and that sometimes mean they're not moving physically, right?
Hmm.
And then, when you're stuck in the same job, it may mean, maybe you're not optimizing your income opportunity, maybe, um, you are not in the best housing situation. You may want to not downgrade, but
Downsize.
downsize, downsize. Yeah, yeah, yeah. And so, we are sort of again in this frozen situation, but overall, I think 2026 has still a lot of potential for some
Mhm.
expansion. Um, Generally up until this point, the forecasts were for positive GDP growth. A
Hmm.
lot of it is being brought in by AI investment, which has a positives and negatives. One is, the investment is boosting economic growth and productivity, but people are worried about losing their jobs, right? People are
Hmm.
constant, like talking, everything I hear these days is about, how AI is going to impact the labor markets going forward. So we do sort of worry a little bit about that. But let's actually move to next slide, which is, specifically sort of to how this impacts non-QM or non-agency box is this K-shaped economy, right? So what we've increasingly seeing in the economy is that because of the wealth effects from rising equities from the amount of homeowner wealth, the homeowner equity increases that we've seen due to higher home prices, higher segments of the income distribution have done better, right? They've seen a lot of,
Hmm.
and particularly if you look at on the right hand side, that's the aggregate wealth changes by income percentile over the last 5 years, and you can see how much more 50th through 100th percentile of income distribution, how much more wealth gain there's been, upwards of 30 plus trillion dollars,
Hmm.
whereas the bottom 50% has only seen $3 trillion increase over that. So you have this wedge growing.
Hmm.
But again, for non-agency a component, I guess it bodes well because the higher income households are continue to perform better.
Okay.
Can I
Um,
jump in? Can I jump in real quick, Carl?
sure, Rick, go ahead.
Um, two things. Before we scare everybody off the webinar by telling them how bad everything is, I did want to point out that if you dig down deeper into the jobs numbers, one of the things that we're seeing is there's either a record or a near record number of people moving from a corporate job into a position where they're self-employed. So
Hmm.
we in the last quarter, I believe we had a record number of business applications filed. There are people like me who left a corporate job 3 years ago and have been very happily doing my own little consulting business
Hmm.
and honestly making as much or more money as I was in my corporate job, but don't necessarily qualify on paper for
Yep.
that Fannie and Freddie loan. So if you're in the non-QM space, there's a growing cohort of people who really, fit that profile,
Hmm.
have high credit scores, have a lot of income, but don't get that W-2. So there are opportunities here. And the other point I wanted to make is that I think someone's right about AI. We're seeing a lot of investment in AI. That's going to be a really interesting phenomenon to watch. I want people to kind of take a step back and take a deep breath before they're worried that everything will be replaced by AI bots. I mentioned I spent the first half of my career doing technology marketing, and this is about the fifth technology cycle I've been through now that's going to change everything and it's going to eliminate everybody's jobs. And it goes all the way back to the personal computer back in the 1980s. That was going to
Hmm.
eliminate everybody's jobs. Then robotics were going to eliminate everybody's jobs. Then the internet was going to eliminate everybody's jobs. Then mobile technology, and now it's AI. And what happens is we do see jobs eliminated in every one of these cycles. But ironically, what happens is new jobs are created
Yep.
that we hadn't had in the prior cycle and had no way of foreseeing before the technology was implemented. And we're already starting to see a little bit of that with AI. So there's going to be some disruption in the workforce, um, particularly for people without a well-defined skill set. But I don't want people to think that unemployment is going to go to 30% because AI is going to eat up all the jobs.
Yeah, yeah. Well, and you make again, it's a great point that there's people like you and younger workers are transitioning more and more away from sort of standard W-2 jobs to more self-employment, gig economy. And those are, again, typically people that aren't going to qualify for government or conventional. So we've obviously we've been seeing that the non-QM space as a whole as a market share is growing
Yeah.
more than the others, even though, I think everybody still thinks conventional and banks and that's it. But there's a lot of opportunities for potential home ownership outside of a W-2 income stream.
Yep.
Um, so, and I guess for both of you, for those brokers who are here, that deal in the non-QM space, where do you see borrower friction increasing, or where do you see expansions in the eligibility pool or flexibilities?
You want to start?
Go ahead, Selma. You can take a
Ladies
start.
first.
I'll follow.
I mean, I think, well, for the investor portion of non-QM, I think there is a huge fear now. Well, not huge fear. I don't know. Maybe I'm confused about everything that's going on, in terms of the ban on investors versus non-investors and how that's all going to play out. So, I think there may be some holding back, in the process of while we figure out what the final legislation looks like. Um, but I think maybe the other part of the friction could be completely different from that. It's just about property valuation, and the fact that we do see quite a bit of fragmentation across markets and different trends evolving in different markets. And then also, on top of that, the segments that these potential investors are looking at, like short-term rentals and or even long-term rentals, and what's going on in those markets. Like, the short-term rentals seem to be even more fragmented than overall housing markets because of the changing trends in traveling trends,
Mhm.
particularly from
Hmm.
international travelers, and then also worries about some markets where rental rates have come down or are being or short-term rentals or single family rentals are competing with multifamily renters. So I think
Hmm.
those have come to mind first as a biggest fraction, but frictions, sorry, frictions. And fractions.
Infractions.
Yeah.
Carl, I think I agree with everything Selma just said, but one of the biggest friction points remains somewhat elevated mortgage rates.
Hmm.
The affordability levels, and you didn't ask us to prep on this, but we'll talk about it anyway. The affordability levels today are probably the worst still that they've been since the 1980s. And back then, affordability was hit hard because of mortgage rates that were 18, 20, 22%. We're coming out of a very unusual cycle in the history of the US housing market. Coming out of COVID, we saw home prices go up probably by more than 50% in an 18 to 24 month period. And
Hmm.
right on the heels of that, mortgage rates doubled. So the hit to affordability was just phenomenal. And we saw the number of existing home sales drop from 6 million in 2021 to 5 million in 2022. And they've now plateaued at about 4 million a year for the last 3 years. I don't know how Selma feels about this, but I think what the numbers are telling me is that for a population our size and economy our size, 4 million is about the bottom number we would expect to see in terms of existing home sales. And normally we'd probably be selling more like 5 million a year. But it's been a combination of limited inventory, high prices, higher financing costs that have kept things from being better. As
Hmm.
those mortgage rates have come down even a little bit, we've seen a huge surge in purchase loan applications, according to the MBA. So I believe there's a lot of pent-up demand. Demographics suggest that as the population ages, young adults age into the age where they're forming households and want to buy homes, we'd have more sales if affordability was a little bit better. And
Hmm.
that will only take place over time. So wages continue to go up. Mortgage rates have at least flattened, although we'll see what happens because of some of the black swan events, as Selma mentioned. And home prices have flattened or are coming down in some markets. So the combination of those things over time improves affordability. And I do believe there's going to be much more demand coming to market as the conditions improve.
Okay. Well, so with the agency guidelines still sort of tight in certain areas, that's typically where the non-QM volume grows. So let's talk. We're going to switch a little bit. We've talked about investors a little bit. So let's talk about that and the investor and sort of self-employed market a little deeper. Um, and investors, we're talking particularly real estate investors, so people who in the non-QM space are likely to use bank statements, DSCR loans, that kind of stuff, rental properties. Um, so Rick, what are you seeing kind of in terms of investor demand heading into the spring, or are rental fundamentals still fairly strong to support growth, or what are you sort of seeing out there?
Yeah, the research I've conducted, investors are actually surprisingly positive in their outlook. Um, and we've seen continued strong investor purchase activity. Now, Selma and I have slightly different numbers on investor purchases, but they're actually fairly close. We're both around 30% share of market when it comes to
Mhm.
how many home sales are going to investors versus how many are going to traditional owner occupants. Uh, but the numbers can be a little bit misleading, and I wanted to point out that while investor purchases do comprise a higher than usual share of all transactions, they're
Mhm.
actually down year over year. And they've been going down compared to the same quarter on a year over year basis as well. So investors are actually buying fewer single family homes than they had in the prior year, but the percentage that those transactions represent has been going up because of the lower demand in owner occupancy from traditional home buyers. What that tells me, though, is if you're a loan broker, a mortgage broker, a loan officer, an originator of any kind, if you're not talking to real estate investors, you are literally ignoring about a third of the market. And these numbers are strictly for single family homes, the majority of which, and about 18% of all single family homes in the country are owned by non-owner occupants.
Mhm.
And the majority of these are rental properties, whether they're traditional rentals or short-term rentals. And I don't see that appetite slowing down. Fix and flip volume has been down 4 of the last 5 quarters, but there are some indications that it may have also bottomed out, and flippers are actually more optimistic than rental property investors. So I do think 2026 is probably going to be a pretty good year for investor purchases across the country. I'm not sure if Selma agrees with me, but I thought I saw a nod there.
No, I think, I think it's just all the confusion around where the cutoff point is,
Yes.
is where, what impacts, sort of, but I don't know if you have available my slide on the distribution among investor sizes, actually, couple more at this one. Yeah.
Yeah, that's
I
a
think
great
what's
chart.
interesting to me, yeah, so we break them down and totally agree, Rick, on everything you said about the share being elevated because non-investor purchases are down, but investors have come down slightly. But shares always sort of tend to be impacted by levels, right?
Yep.
So, but what's interesting to me here, so this I guess it's a magenta line, the middle line that goes up is, we see sort of the top line is small investors, and they're the largest share of total investor purchases, and
Mhm.
the bottom are mega and large. But these middle size, the medium investors, they have been a growing share. So I definitely feel like whatever the cutoff point is, you stay below that cutoff point in terms of that, size and so and plus I think there are definitely parts of the big beautiful bill that continue to incentivize
Mhm.
investor investments. So the investors are still there. I guess maybe I was thinking more like institutional versus, how it impacts
Yeah, yeah.
very large guys, but small and medium size, I think it's still very much a growing business in 2026.
And the
Yeah.
reality is those major institutions rarely get the kind of loans that we're talking about today.
Right, right,
They're
right. You're
typically
right.
raising their capital differently. We're seeing exactly the same thing, Selma. It's those small and mid-sized investors
Hmm.
who are most active. In fact, the institutions, if you look at what Selma categorizes as the mega investors, have
Mhm.
actually been net sellers for 8 consecutive quarters. They're selling more properties than they're buying. And for anybody who's interested in what Selma's talking about the institutional investor ban on single family
Mhm.
home purchases, the latest rumor out of DC is that the cutoff point will be 350 properties. So if you own 350, you're not going to be able to buy any until you, I guess, get rid of some. But that bill's still being bounced around, and
Mhm.
if they're not careful, what they're going to wind up doing is reducing inventory. But we can save that for another webinar.
Yeah. Yeah, so I mean, so basically brokers should be really looking for products that can deal with the, 4 to 8 unit complexes and don't go chasing after the black rocks. Like you said,
Well,
they're
these are for actually for SFR properties, if I'm not mistaken. I know my numbers are. And when you start getting at 5 plus, you're really dealing
oh yeah,
more
you're
with a commercial loan. But business purpose loans, whether they're all RTL loans or DSCR loans, are absolutely growing. That's you mentioned that non-QM loans are probably
mhm.
one of the few parts of mortgages that are growing, and that's a big component of that non-QM space. And
Yeah.
I think the next slide from Selma was actually showing that DSCRs are growing. But yeah, that's you need to be paying attention to those segments.
Yeah, we'll get to that one. Yeah, so the next question really was for Samus, which is, what trends are you seeing out there among self-employed borrowers? Is wage growth in terms of wage growth patterns, or small business performance, is that helping get more people eligible?
Well, as Rick said that you guys talked about earlier, the self-employed segment of the workforce is definitely growing, and it's, a major engine of the economy. It's really what I forgot. Is it 60% of U.S. businesses or small businesses, or
Something like that. Yeah.
yeah, 60% of employment is in small businesses. So, I definitely think that that's a growing segment. Now, in terms of the wage growth, I think, wage growth has slowed from, where we were during the pandemic. And I think now we are at that point where, things could go cool significantly or could actually end up heating up again. It depends on how the immigrant, and we have not yet fully seen this, I think, in the data. Like, how does the immigration policy impact small businesses?
Mhm.
How does AI impact small business wages? But there are still the other thing is again on the lower versus higher income wage growth, higher income earners, which probably would be somebody who would be looking to for a loan, they are now growing at a faster pace again. During the pandemic, we saw a lower income wages grow faster, but now again we see higher income wages grow faster. So it's a
It's
bit
a
of a
mixed
turning
grab bag.
point. Yes, yes.
Okay, so based on that too, it is the spring looking good for these alternative income products, the DSCR loans and um, bank statements, sorry, not W-2, 1099s, that kind of stuff. Um, I mean, where should brokers be looking now to really be competitive, particularly with let's first look at that investor space that we were talking about. If they're looking to work with investors.
Well, there's the chart you had up from Selma, I think really is indicative. The private lenders that I've talked to and the investors that I've surveyed seem to skew more heavily toward DSCR loans right now than
Mhm.
they do toward fix and flip loans. In fact, in the investor research I've done for the last few years, it's not unusual to see twice as many investors aiming at rental properties as they have been at buying properties to fix and flip. And I think that's just indicative of housing market conditions right now. So I think there will be a market opportunity for both. I
Mhm.
also think there are going to be non-QM market opportunities for more traditional home buyers who again don't fit nicely into that conventional loan box because they don't have a W-2.
Mhm.
So I think that's where you're going to see a lot of the growth this year. There's a move by the Federal Reserve. One of the governors, Mickey Bowman, is trying to reduce capital requirements for banks to encourage them to get back into lending. But banks aren't going to do non-QM loans. They're going to stay in that conventional loan box. So I think, sharpening up your skill set and your sales tools for getting to borrowers who are looking to buy rental properties or looking to buy a property to move into are where you're going to see opportunities, not just this spring, but for the rest of the year.
Okay. All right, so let's kind of talk about some revenue strategies for the broker community. So if you're advising a broker now that focuses on non-QM, what borrower segments should they be going after? I mean, again, we kind of dance around bits and pieces, whether it's investors or self-employed. But I think we've got some opportunities out there to take a look at, especially now that we're going into tax season. I think everybody's totally focused on their W-2 or non-W-2. I'll feel that Rick, you want to take that one or Selma?
I, I think I just answered that one
Oh,
from my perspective anyway,
okay.
which is again, a third of the market is investors. Most of them, the majority of them, are looking at rental property acquisition, and then you have an underserved element of the owner occupant community that is, you know, W-9 employees, people that are self-employed, gig economy workers, and to a certain extent, you're also looking at non-traditional mortgages that are maybe multifamily. I hate to use that word, multi-generational buyers. So you have multiple people on a mortgage.
Mhm.
Maybe the grandparents, the parents, and the adult kids all chipping in to be able to qualify for that loan, and that drives a traditional loan officer crazy because it doesn't fit in the box very nicely, and they have to qualify multiple people. So I think there's all those opportunities, and let's not throw the baby out with the bathwater. There are still going to be a lot of opportunities for government loans and for conventional loans that maybe are
Mhm.
Fannie and Freddie eligible. So bottom line is, and I think Selma and I are on the same page here. at least as we entered 2026, both of us believe we'll see both more existing home sales and more new home sales over the course of the year, and than we did in the prior year. And I think that just makes more opportunities available for all lenders.
Yeah.
So,
Do you guys have any particular markets that you're looking at as sort of the next hot housing markets? I think we had some slides. I'd like
geographically,
to, yeah, geographically.
population continues to move from high price markets to lower price markets, but they're not doing it at the same rate they've been doing coming out of COVID. So you're still seeing um, more people moving into markets in the Southeast and the South. They're just not doing it in numbers quite as large, and you're still seeing six-figure population declines in the Californias and New Yorks and Illinois of the world as that happens. And so you have investors targeting those markets, but you also have traditional home buyers moving into those markets. And so if you're able to do loans in multiple states, you might want to take a look at those types of states in your loan portfolio.
I'm trying to find
You
it.
know, I piggyback on the previous thing, I just wondered to what degree maybe also non-citizen like H-1B buyers
Oh yeah.
become
More
a
national,
growing
yeah.
group. Yeah, growing group because, of inability to get conventional loans. So that's one thing. But yeah, and then piggyback on the second question, just in terms of the regions, what we saw is yes, definitely transition to affordability being a major constraint for many. Also, having affordability and accessibility. So whether it's proximity to a major employment centers like New York or Boston, and but not living in those major urban centers, living in some reasonable, driving or train distance, like a couple hours away.
Hmm.
So we see a lot of these small towns, like in Pennsylvania and New York, that actually, to some degree have been forgotten for a long time.
Hmm.
Now see a lot of renaissance in those towns. So, I would say that that's another potential for sure. Um, for the growing demand.
Okay.
And as you can, yeah, so you can, yeah, so, this goes back to property valuations, just how bifurcated markets are. You see Northeast and Midwest continuing to be really strong. That's indicated by the purple, meaning that
Hmm.
I think it's missing in my legend, but it's supposed to be more than 6%. It just says more than percent increase.
Yeah.
It's supposed to be more than 6% increase. And then you have these markets that are resetting in Florida and Texas and parts of the Southeast. And actually, an interesting, if you go to the following slide, it sort of shows you how where markets are, sort of the change over the last 5 year period, and um, the reset maybe just cumulative appreciation over since the onset of the pandemic and resetting from those high levels because in migration to those areas has slowed, as Rick mentioned, or population growth or wage growth is not as strong.
Hmm.
Austin, for example, and um, parts of Florida, Gulf Coast, Florida, cumulatively are down the most since their peaks. And that speaks to that change in migration patterns to those areas.
Interesting. What was our next one? Yeah, okay. Yeah, well, as we've talked about with rates, they're still volatile. How would brokers structure conversations with investors that are more sort of payment sensitive than rate sensitive?
How should brokers talk to those borrowers?
Yeah.
I mean, I think I don't not sure if this is the right way to look at it, but maybe, shifting the conversation to cash flow. If
Hmm.
it's a rental property, if you can cover your expenses with your cash flow, with rental income, and then ultimately the return on that investment. And then again, just, the tax benefit, I think, still, outweigh a lot of these other things.
Yeah, I mean, there's a fine line. A lot of borrowers are payment sensitive because they simply can't afford a higher payment. And pushing them into a loan that they really can't afford is not a good recipe for success in the long run. Um, so, maybe the conversation is you need to be looking at a less expensive property if you can't afford it. But the other point I think goes to what Selma was saying. If you look at things over a longer term, a longer time horizon, you have to kind of factor in that maybe a payment a little higher than what you were hoping for today could still be very beneficial in the long run. So you need to take a longer time horizon view on some of these things. But each loan, and the attendees today know this better than we do, every loan is very unique and has different conditions involved. And sometimes for the greater good, and maybe for a better long-term relationship with the borrower, the honest answer is maybe not today, but let's get back again tomorrow when conditions are better.
Okay. All right. Well, then let's shift over a little bit to the capital markets. That's obviously dictates a lot of trends that are happening pretty much across the country. So, Rick, from a capital markets perspective, are you seeing appetite expand or tighten again for the non-traditional products, or what's what's what's
Yeah,
your what's your read?
actually, some good news for people that are issuing non-QM loans is that there is an enormous appetite in the secondary market for these loans if they're underwritten properly and are performing as expected. And in the third quarter of last year, there was a record number of securities issued. And for those of you not all that familiar with securities, these are loans that are pooled together and sold off on the secondary market. That was the slide. You just went past
Yeah.
it. And you can see that in the third quarter, there were about $21 billion of residential mortgage-backed securities that were based on non-QM loans. So there should be no shortage of capital available to write loans against for the foreseeable future. I just came from a conference last week where I was on a panel talking about the first rated RTL loans securities. So these
Hmm.
were mortgage-backed securities that were 100% made up of fix and flip loans. And they were actually viewed by the rating agencies and given strong ratings. I'm going to be on a call right after this talking about another non-QM securitization of about 350, $360 billion, all non-QM loans. So lots and lots of interest in the secondary markets, which means there should be lots and lots of capital, no
Hmm.
shortage of liquidity. You shouldn't be worried as a mortgage broker, as a lender that you're going to run out of dollars available to do non-QM loans this year.
And Selma, what risks do you see? I know we've talked about the black swan events a bit today here, but that could impact overall both investor confidence or the rental performance this year.
I mean, I suppose the labor market is if you start seeing people laid off, in large numbers, we haven't seen that yet. But seeing, large layoffs, I think that would really shake the confidence, particularly for the rental market. So, and like I said, the picture is so mixed at the moment. And there's, the data, there's so much questions around the data quality, and different data providers, give you different ideas of where the labor market is heading. So that's the focus of my attention right now, I think.
Yeah, you've got a good slide here too. Like you said, that at least DSCR loans are definitely outperforming from a delinquency standpoint, traditional agency
Hmm.
loans. So there's again, we keep emphasizing DSCR loans in this discussion here today. Those are one of our specialties. So that's, at least from us as a lender perspective, it's good news. And then hopefully from a perspective of a broker, that's again where there's some really good opportunities in terms of the shift in the employment base, the income streams, and then the availability of rental properties, particularly in some of these hotter markets that you're mentioning.
Yeah, Carl, you mentioned multifamily loans earlier, and I think it's probably worth pointing out the difference in performance of multifamily loans versus these single family loans, which is
Hmm.
typically what a DSCR is used for. Fannie and Freddie are both reporting the highest level of delinquencies on their multifamily loans that they've seen since the Great Recession. And I don't have a chart on that.
Yep.
Um, and uh, and I think it's indicative of what's going on in the apartment market, the rental market. Selma referred to that earlier,
Hmm.
in that we've seen rental rates actually go down in large swaths of the country on a year-over-year basis. And that's because we had over a million apartments come online in the last 18 months or so. It's one of um, the largest influx of new apartments in a period like that for decades.
Hmm.
And in some markets, we wound up with a bit of an oversupply. And we've seen vacancy rates go up over 6% nationally. As a result of that, we've seen asking rents come down. And I think that's made it very difficult for some multifamily units, some apartment owners to make the math work, particularly as their loans have reset and they've had to adjust to higher financing costs. And contrary to that, even though rental rates have slowed down a bit in terms of year-over-year growth for the single family market, at the very least, they're still positive.
Hmm.
And so we're not seeing quite the same attrition there as we're seeing in the multifamily market.
Hmm. Interesting. Um, okay, so we're kind of getting close to the end here. Let me just throw the big question out there then. So for the next 90 days, brokers are going to be wanting to look either where, in terms of markets or sub markets to try to find borrowers. I think we've identified a few areas, and then um, what particular types of loans should they be looking at, especially with these more self-employed borrowers.
Go ahead,
So,
Selma.
uh,
Yeah, I'm an economist. I don't usually answer this.
yeah.
I'm not a good business person.
Rick, then let Rick answer that one. He put him on the hook for that one.
Well,
Well,
there's also the reality that um, if you're dealing with a borrower in Tennessee, they're not likely to be looking for homes in Alaska.
hmm.
And even if you look at investor purchase activity, you find that over 80% of the investors only buy in their home states. If you look at where most of those investors own properties, the three biggest states are California, Texas, and Florida. Actually,
Hmm.
it's not that order, it's Texas, California, and Florida. And if you add North Carolina and Georgia to that list, that represents about 30% of all investor-owned properties. If you can become an expert at specialization, you could be looking at markets like Maine, Montana, Alaska, Hawaii, as states
Hmm.
where you can make loans that short-term rental buyers are interested in, because all four of those states have investor ownership around 30%. And that's because they tend to be somewhat sparsely populated, but very heavily dependent on tourism for their economy. So they have a
Hmm.
ton of vacation homes and short-term rentals in those states. But reality is, we have a growing number of borrowers, of potential borrowers, who are self-employed, who are gig employed, who really make themselves prime candidates for non-QM loans. There are,
Hmm.
again, no shortage of interest from large institutional investors, private equity firms, insurance companies who are interested in buying those loans either as whole loans or securities, and that'll keep the capital flowing. And the reality is there's opportunities in every state, wherever you are.
Hmm.
You just need to make yourself known as somebody who can help those non-traditional lenders, whether they're investors or owner occupants, get the financing they need to achieve their dream of home ownership.
Okay, great. Um, and Selma's got a couple of great slides that I do want to bring into this because it does um,
Can
impact
I
this
actually
industry.
add,
Uh,
just from a,
oh,
and I,
go ahead.
now I thought it would be a good answer to the question as I was listening to Rick, and going back to my importance of the labor market and migration patterns,
Yeah.
So, we do know, so we already talked about, slowdown in, like Florida, Texas, in Texas as well. You have Arizona, Colorado, some other states slow down in net in migration. But then you have, Pennsylvania I mentioned earlier, Ohio, North Carolina, getting not just increase in population number of in migration increasing, but also job creation
Yep.
of
Mhm.
Great point.
higher income households,
Mhm.
biotech, pharmaceutical, financial services. And so, these would, and we see that in home price appreciation being relatively more resilient in those areas. So just throwing something in the mix.
Yeah, yeah, yeah. Yeah, one of the things that I've encountered in the years that I've been doing non-QM, in particular, is brokers who are now dealing with Gen Z and call it the late millennial buyers. They're not really, I don't want to say financially literate, but they don't understand all the components that go into home ownership. So they're thinking, you know, P&I, principal and interest, and that's it. But there's
Mhm.
all those hidden costs, those the non-mortgage costs um, that I want to kick this over to Selma because she's got some great slides that look at several markets from those particular economic elements that would influence where some of these opportunities are going to be. So you want to talk a little bit about mortgage insurance, property insurance, that kind of stuff that's been increasing in some specific markets.
Yeah.
Selma, because you had a lot of really great data here that I think is valuable to brokers who, well, let me get the slides. I swear to God, I have them.
Absolutely. Yeah, if you want to skip over to those, so non-mortgage component of homeownership costs have, been a big issue over the last few years, especially with the surging cost of insurance, but then also property taxes. So have been paying attention to escrow amounts, to how much people have in escrow accounts and, shortages, and those shortages potentially impacting delinquency rates. And so, in this particular map, you're looking at the change in escrow amounts over a 5-year period. And on
Mhm.
average, there's been a 30% increase. And obviously in the states with, that have been more exposed to impact of higher insurance costs, like Florida, Colorado, for example, you're seeing much larger increases in escrow. And then, on the flip side, I don't have it here, but in terms of the shortages, we did see, for example, Florida and Texas have more than half accounts have shortages of more than $2,000 for
Mhm.
the escrow payment, annual escrow payment, right? And so why that matters again, it goes back to the whether people have financial buffers to pay for that. And then does that ultimately lead to delinquency if they don't, for example, even have home equity, if they're more recent buyers. Um, so anyways, a lot of concern around that. So, so this one slide shows you the changes in escrow, and then the next two slides show impact of the two primary components to the escrow, non-mortgage components to the escrow payment, which is the insurance and
Mhm.
property taxes, and those have gone up quite a bit as well. In so much talk over the last few years about how much insurance costs have gone up. Now I was just listening to something recently showing that yeah, so at least that the rate of increase is not at the same level that we've seen during those, sort of worst years of increases. But even in 2026, the expected growth of average insurance premiums about 8%. But on the right hand side, you can see over the 2-year period just how much increase that there's been in some states. You know, ranging from very low. And so, so relative, related to that, what we talk a lot about lately is how migration patterns are being impacted by
Mhm.
these costs, how those costs affect affordability, and maybe the reasons behind changes in mobility destinations, right? Or where people are moving to, maybe not moving as much to Florida around concerns of those insurance costs.
All right, great. Well, that'll be kind of our last topic area. Rick's got a hard stop in a few minutes. He may have to drop off. So let's open the floor up to questions. So if anybody has a question for Rick, you've got 5 minutes. I'll let you think about it for a minute while I kind of go into my wrap up spiel, and give people time to kind of do their thing. So a couple real quick things. We've launched a promotion this month on our DSCR property, or DSCR loans, and all the other non-QM pieces. So if you can get your loans in by the end of this month and close by the end of next month, we'll be offering some pricing improvements. For those people that joined late, I failed to mention we are recording this, and I'll be sending out the PowerPoint decks for those people who have enrolled. Couple other things. We offer a number of tools in addition to the webinars and broker education things that we do here. We do have white label flyers for you guys on our various products, including the DSCR loans that we've been talking quite a bit about today. I would advise you guys to join our social media so you can find out all the other educational aspects that we do here on behalf of the non-QM space to help you guys understand the borrowers, the loan products, because we still see that, even though non-QMs existed for a long time at this point, there's still a lot of confusion. One of my major roles is to help educate the broker community about who's the right what's the right product, the right fit, the right people. We also announce our webinars through our social media channel, and also encourage you to enjoy our newsletters. Um, we've recently begun offering personal training to brokers. I'm not going to go into this too much, but if you need some specialty training on any of our specific products, we can arrange those for you with our new SVP. So we'll cover that, and then we'll be at a couple of trade shows next week. We'll be doing a panel actually on particularly the condo market within Florida. So if you're going to be in the Fort Lauderdale area, stop by and check that out. And we do not have a current webinar for April lined up, but we'll be lining that up probably in the next 2 weeks or so and making those announcements. Yes, you will also be receiving a copy of the recording. It will probably be on Monday. It's going to take it a while to process. Um, and that's always like my number one question. So, and then just so I'm clear, Rick, Selma, you guys are okay with me distributing your slides to okay, just that way they have it. Because we didn't cover everything, obviously, but there's a ton of data in here. And you can reach out to me if you have any questions from the data, and I'll forward those out to Rick and Selma, and we can get those back to you if there's any particular areas that you're interested in hearing about. So with that, that is I believe the last of our questions that came in. Yep. So with that, I want to thank Dr. Heap. Sorry, I had to do it again. And Rick Sharga for their observations and their insights into what's happening in the spring housing market. We will hopefully be doing this again in the fall if everyone is willing and we get good results. When you go to log out, there'll be a brief, like 5 question survey. Let us know how we did. If there's any particular topics that uh, you want to hear more about, we will be happy to put those types of webinars together in the future. And let us know if you enjoyed Rick and Selma, and we'll bring them back in the future as well. So with that, I will close this out for the night. Thank you, Rick. Thank you, Selma. Great job. Appreciate it. And hope everybody has a productive March.
Thanks for having me,
Okay.
David. It was a pleasure.
You're welcome.
Take care.